We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor. This week, I am rebroadcasting an interview that I did a few weeks ago on the podcast Swimming with Allocators, which is a VC-focused podcast from the LP perspective. And I was invited to talk and share some of my views on the world of not just venture capital, but private investments in general. So if you want to get deep in on my investment philosophy, this is going to be the episode for you. And if you want to always stay in tune with my latest insights, you can sign up for my newsletter using the link at the top of the episode description. And now, here is my conversation on swimming with allocators.
Welcome to Swimming with Allocators. Today we have Peter Lazaroff as our guest. He's the Chief Investment Officer at PlanCorp and the host of Cheddar's The Long-Term Investor Podcast, of which I am an avid listener. And after hearing from him, I think you will be too. Today we've invited him on because most of our guests are bullish on venture as an asset class. And here we have an RIA who is not recommending venture to his clients. And we thought that would be helpful for both the allocators and the GPs listening to hear from the other side. He's also going to share with us some of the popular tools he's developed for clients and the thesis of his upcoming book. Thanks, Peter.
Alexa, Ernest, thanks for having me.
Our resident hater, thank you for coming on the show.
We've had a few. The more the merrier.
Peter is in Missouri. He's overseeing $8 billion in assets across over, 1,500 clients.
Yeah.
So can you just give us a quick overview of your investment philosophy so people can understand where you're coming from?
Sure. I think the most important thing I could say about my philosophy is that I'm more worried about implementing a bad idea than missing out on a good one. And let me give a little context. The example I always give is the FDA, when they seek to approve a drug, they're trying to approve a drug without it having crazy side effects. And every drug has some side effects. That's why they have the people who can do fast reads. I cannot do the fast read. The other side of that is that sometimes the FDA is a little too stringent and they fail to approve a drug because there's bad side effects, but it would have been a net positive to society. And so what we're talking about for statistics lovers is type 1 error and type 2 error. You have false positives, you have false negatives. And I think that ultimately, investment success comes down to minimizing mistakes and making sure that you don't interrupt compound interest. And I think in general, I don't think you can only index and that's all you should do. I think index funds are great, but I don't use index funds myself. I do only use one fund, though. It's 100% globally diversified. It is what would be considered a factor fund. So rules-based, like an index, but not index investing itself. And for our clients, we have a couple different strategies that are just focused on, hey, rules-based, repeatable, process-driven, not going to predict the future. And really leaning on that, I'm more concerned about minimizing type 1 error. If you want to totally minimize type 1 error, that means owning the market portfolio and nothing else. If you want to minimize type 2 error, you have to add everything with a good back test to your portfolio. And so let me go full circle there. I'm more concerned with implementing a bad idea than missing out on a good one. And when you go through that lens, the bar is higher for inclusion. And so I think what's exciting, I've listened to the show. I've known Alexa for a while. And when she told me she had a podcast, I went back to episode 1 and started plowing through. I'm like, yeah, everyone loves venture. Let's get it clear. I don't hate venture. I just don't think it's for everybody. And I think privates in general, I don't think are for everybody. So that's a quick global view of how I see investing.
Wow. What a way to start. When you talk about your lens, Peter, it's definitely very different than talking to two GPs here like us, where it's like, yeah, what's wrong with betting the house? You have to turn over every rock to find that golden nugget. I'm always curious, what shaped your investment philosophy throughout your career?
Well, I started my career as an individual stock analyst, and I had a lot of success. And I have loved stocks, broadly speaking, since I was a kid. My grandmother gave me a share of Nike stock for my 12th birthday, and it split right away. Actually, by the time she had gifted it to me on my birthday, I have a December 20th birthday. My family celebrates Hanukkah and Christmas, so we got a lot of stuff going on in December. But she had bought the shares of Nike for me, I think in November through her broker, and they'd already split. And by February, they split again. Later in the fall of that first year of me owning it, it split again. So suddenly I had 8 shares of Nike. I'm getting this $1 dividend check in the mail, and I'm thinking, this is great. So I was all in. Anything that had to do with making money as a kid, I'm like, this is cool. I want to learn more about this. So when I was a stock analyst, I didn't know a lot about the world like much of us when we graduate from school. And I was having a lot of success, but I was learning a lot. And I think I accidentally stumbled onto a book. I was reading, Barry Ritholtz had a blog called The Big Picture, and blogs were just starting to have their day in the sun. And he was pointing to a lot of resources I hadn't ever seen before. And there was one in particular, Michael Mauboussin, who is still one of my favorite investment thinkers, had written a very obscure paper on skill versus luck. And I think that ended up taking me down a very, very big rabbit hole that made me realize my success as a stock picker might be more luck driven than anything.
You're the monkey who just wrote Shakespeare.
Absolutely.
Yes. What's weird about it, though, is what I've come to learn about stock picking in general. I mean, I used to own a lot of individual stocks. I don't currently own any individual stocks. And the last time I had a seemingly dying urge to buy individual stocks was during the pandemic. Because that was the first time to me since the financial crisis that I would see valuations where basically the stock is priced like it might go bankrupt. And then you're out there just picking things that you don't think are going bankrupt. And I remember telling myself, man, Nordstrom's not going to go bankrupt. Amazon will buy them. Because I'd already thought that Amazon would buy them. It would help their distribution. Amazon wanted to get into clothing. I'd made up this narrative that would have forced to buy. And the thing about individual stock picking is everybody's got a ton of information. You just have to hope that everybody sees your view of the world eventually. And you're making up stories. And individual stock picking, very luck driven, but very story driven, probably more so than in the 80s and 90s when stock picking was a little bit more just about fundamentals. You're really trying to predict valuations. Now, here's the thing where I think the parallel to venture is super interesting. So if you go buy the Russell 3000, which there aren't actually 3,000 companies in, but let's just say there are. Roughly 4% of those individual companies are driving all the returns. Does that sound familiar? I mean, it's not that different than venture capital. It's just you are betting on bigger companies who are reporting more regularly and have more public information. And so price discovery is different. In venture or in private equity of any kind, really, price discovery is minimal. And there's a lot of easy ways to be critical. And I'm not saying they're untrue, but I think some people have skin in the game in the sense of they want privates to be bad. I don't care if privates are good or bad. I think there's merit to some of the volatility washing, to some of the way that people mark prices. But at the end of the day, it's just not as efficient of price discovery. So it's kind of the same mechanism. And that's why I wanted to emphasize, hey, I'm not anti-venture. I think it's just when does your balance sheet allow for you to take that kind of risk in general? Ernest, I'm way off the path of how did I get this investment philosophy? So let me pause and see where we should go. I just realized this has nothing to do with what you asked me, but here we are. That parallel between, it's hard to pick stocks. I am fascinated with stocks. I am fascinated with human behavior. I think that private investing and public investing have more in common than most people realize. And it's one of those, it's not quite interdisciplinary, but anytime you start crossing disciplines, you start seeing that a lot of things in our world actually are quite similar as for how they all work.
That's absolutely true. It reminds me of a conversation I had earlier this week with someone who was an emerging manager in the hedge fund world. And he was explaining to me why he felt the need, it was the right time to start a new multi-strat hedge fund, and bringing up the same thing of some of the biggest players have gotten really big and are just asset allocators, and their misalignment of incentives has not generated as much talent and novel ideas as in the past. So there's stifled talent internally, and there's a better way. And so I was like, man, that sounds very familiar. But to that point, with the blending of all the worlds, how does that change actually what you recommend a lot of your clients to do?
So PlanCorp serves high net worth clients, which can mean a lot of things to a lot of different people. But if you just do simple math of the assets we're managing divided by the number of clients we have, let's say the average client has about $5 million. The average investor in the world, and this is theory, but it's also true, The average investor, if we all put our money into a pot and then we divide it evenly, we all own the market portfolio. And so the average investor owns the market portfolio. So what I always do is I ask people, well, how are you different than average? The market portfolio is amazing. There's not going to be a person who's going to convince me that it's a bad investment. I think it can be improved upon, but if you choose the market portfolio, you do it. There is nothing wrong with that. You're going to do great. Could you do better? Maybe. Does that matter? Maybe not. So I'm always asking, how are you different than average? Are your liquidity needs relative to the size of your portfolio different than the average investor? Some people that we work with, I say the average is $5 million, but we have a couple billionaires where maybe we're not managing all their money, but we might have a couple $100 million of it. They are overweight liquidity relative to the average investor. I think that's actually a key point when privates come into play is once you're overweight liquidity, then you should take some more illiquid risks. It's pretty straightforward. And so when we communicate to clients, we talk about how are you different than average? We think a lot about the financial plan before the investing. So in many ways, I'm the sideshow here. Our firm was started over 40 years ago as a fee-only financial planning firm, something that wasn't really even a thing and is borderline an insane business plan to have had back then. Now it's pretty normal. On one hand, the RIA space has maybe not overly commoditized the active asset management, but there has been, thanks to technology, a lot of scaling and systematizing where when you go to an RIA, you're going to get a diversified portfolio. They're going to try to keep costs low. How they implement around the edges probably makes a difference, but it's not wildly different outcomes if you're globally diversified and not trying to predict the future and keeping costs low. I think where things are different is how can you customize? So the toolbox is where things suddenly become less commoditized. So do you have a lot of concentration in a particular sector of the economy, either through your job or your actual portfolio? Do you have a pain point with capital gains? Do you have very specific legacy goals? Do you have a special needs child? Once you start bringing in, how am I different than average, is when your portfolio starts to not just deviate from the market portfolio, but deviate in the vehicle that you're going to use to achieve those goals. And so I think in general, one of the things that has probably played a huge role in the way I think through portfolio construction as well as communication is I started as an analyst, but after an analyst, I probably should have mentioned this, I was an advisor. I had a book of business. I think over 80% of it was physicians. So I'd said FDA. I haven't had any other. You just wait. There's going to be more medical analogies because it's just deeply ingrained in me at this point. My parents are physicians. I was working with all physicians.
Oh, okay.
I don't know. Maybe I was supposed to be a doctor at some point. But I think in general, when you're talking to clients, that's the big thing. If the average person owns the market portfolio, how are you different than average? And why does that matter? And that's the framework where you start to explore some of those deviations. And I think all portfolios are some combination of market portfolio, strategic tilts, active bets. And then I think you get into that illiquid versus illiquid proportions of the portfolio. Now that piece definitely hits where your guys' area of expertise lies, but it also hits a lot of other people's. And I think every portfolio, that's the framework, no matter who you're looking at. No, people might be zeroed out in some of those categories, but you're still going through that framework.
So would you say that it's potentially beneficial, but not necessarily for everyone? Who is the potentially? It's just those billionaires who need to rebalance their liquidity?
I think a big piece of what we do with privates that's different than other people who run firms our size is that most times when you're in a role like mine at a big investment advisor, you're trying to make portfolio decisions that are durable and scalable across multiple advisors and locations. And our private allocation is the one place where we are highly customized. And I think one of the issues that I have with privates as a whole right now and the way that they're getting adopted is it feels like because the access is changing and they're becoming easier to implement these more durable, scalable options, what's happening is people are treating exposures more like a line item in an asset allocation pie and less like a specific purpose-driven investment. And when it comes to privates, I'm broad stroke putting privates, we can go more niche if we want to, but what's really important to me when we add privates is that we understand the why the client wants to use privates in some capacity or alternatives of any kind, because they're alts that aren't privates per se. That to me means so much because it isn't always a financial reason. And that can lead to different categories. We have some models. If I won the lottery and had $100 million of after-tax money, I wouldn't use our models. Our models are these durable, scalable things. And do they give you exposure to the narrative of private investment? Yes, they do. You and your audience probably really understand the impact of dispersion in this space. And so while maybe I can feel comfortable that we won't be in the bottom 50%, how comfortable am I that we're in the top 25%? Because being in that second 25% is not that great. So
not at all.
And I'm not saying the models can't do it. If I have $100 million after tax, I'm probably doing privates. But you know what I'm doing is I'm investing in things that I'm personally interested in. I'm investing in friends who I believe in. I'm investing in ventures where I get to have an active role in it. So there's purpose. I think purpose is so important. I would say that one of the things that people do a poor job of when salespeople reach out is they're just pitching product. And I think they've never worked with clients. Maybe it's not a fair criticism, but for me, I think that generally, let me take private credit. This is a great example. I have a really hard time wrapping my head around the appropriate use case for private credit for a taxable investor. If you talk to a lot of people in my role, they won't put private credit in something that isn't a qualified account like an IRA or a Roth IRA. The thing is, the best use case that I've found for private credit to date is there's a gentleman we work with. He's got, I don't know, $40 or $50 million. And he just wants to make annual exclusion gifts to all his grandkids and kids. But he's not liquid enough to write these checks. And so he needs something to spit out yield. But the after-tax yield isn't all that good for how much risk you're taking. And so you could have a model that's an income model and it has some private credit in it, it has some private equity, maybe it has some infrastructure or real estate. And the models, they look cool. And sometimes that is one of the objectives. And people are embarrassed to say it. And I was like, don't feel embarrassed. You want something cool to talk about at the country club? That is not something to be embarrassed about. If you can afford to do that, why not do it intentionally and have something cool? I keep going on these long tangents, trying to go all the way back to the beginning. I think who is it right for and how do you determine what it looks like is really individually driven. I think where I'm seeing the most interest today remains in the private credit space. What I would say, what people feel about venture capital is, God, the word that comes to mind is hopeless. How are we supposed to know? I don't think that's really the word I want to use, but I think with private equity, it's more established. It feels safer. Whereas people who have done venture in the past usually have some scars and bruising to show from it. And if they haven't done it, usually they're asking the type of questions that would signal a misalignment of expectations and reality. And we all know that the distance between expectation and reality is what equals happiness or unhappiness. I feel like I end up talking people out of venture who come and have never done it before and are talking about finding the next big thing. Whereas really, and actually, I would love for you guys to point out where you think I'm wrong with this next line. To me, when you're investing in a fund, you're investing in that team's network. Because even if I know who has the next Google, they're not taking my money. They have to want to work with the person who's collecting and seeding in the first place. And so I feel like I do actually have a good network. But to really flex that network, I would have to be writing bigger checks than what I can write on behalf of my clients. Even if we have $8 billion, I would need everybody to adopt it because they want the big consistent money. And that's okay. And so I think it's knowing what are the rules to the game? Can I play this game or not? And then why am I playing the game in the first place? None of this has anything to do yet with risk and return or liquidity or not, if you'll notice. I think it's a lot of just really trying to align allocations with goals. And then after that, educate, educate, educate. Keep expectations and reality as close as possible. Constantly update expectations because when they separate is when people get upset. And when people get upset, they bail. And when they bail, it's usually at the wrong time. Now, that's true not just with privates. It's true with public equities. I mean, the past decade, all I've been telling clients is, no, don't sell your international stocks. You need international stocks. So it's kind of the same thing, just different sleeves of the asset allocation pie.
This is incredibly helpful because I think 90% of our audience are GPs fundraising. They forget all the reasons why.
They forget who's the people who are ultimately buying the fund.
100%. They're out there selling. And you're like, remember the universe that you're in. Even if you're just pitching a high net worth, you are top of the pyramid in terms of people who think a lot about this. But still, your average high net worth, this is their universe too, as opposed to which VC fund should I pick? So meanwhile, all the other RIAs are offering alts in mass. So what do you suspect they're doing and why?
Well, I think it's easier for an advisor to sell complexity. That's the baseline of what I think is happening. What's also interesting, so I am a part of a couple different CIO forums or executive groups that host firms that are my size or bigger. And when I talk to CIOs, sometimes people are just really passionate in the story, the numbers, all of it. Some are saying, well, the advisors and clients say we have to have it. And so that's why I do the work. Then you have other people who are a little bit indifferent and a little bit unsure of what they even think about their own solution. I'm usually surprised at the percentage of allocators who are confident in their allocation to privates, to alternatives. The more client experience you've had, I've also come to realize that less likely you are to embrace alternatives. If you're a CIO and your entire life has been spent on that path of analyst to research manager, where you were never an advisor, and you never had to deal with the emotion of a client who doesn't really understand what they're looking at, that does lead to different portfolio design decisions. And I'll often tell clients, look, if I knew that I could be sitting right next to you every single time you open up your brokerage app on your phone or every time you open up our performance statement, you might actually hold a different portfolio. Not materially different, but there are things the research shows are very beneficial, oftentimes in the diversification space. And maybe I'm being overly basic here, but you diversify because by lowering volatility, compound interest works better. And remember, all I said is we just want to compound stuff. It's really all this simple. But diversification looks and feels awful in the moment. And it makes you as an advisor look stupid. Of course, international was going to underperform. Of course, catastrophic bonds are going to do poorly in a hurricane or whatever. I'm actually thrilled that we avoided the catastrophe bond bullet. That's a great example of the people who buy liquid alts like that. I mean, there's job security in it. I think they would disagree. I think if we got in a debate and I would shrug my shoulders and just say, okay. When you can run something that's simple and everyone can understand, you do risk a little bit of what do you do all day? And that even happens internally at Plan Corp. All of a sudden, I'll pull out some of the work that we're doing at the investment committee level and people will be like, oh my gosh. Because when you say no 10,000 times for every one yes, it doesn't look like you're doing very much. But you do have to go through the process. And the thing about privates and alternatives in general, and this is more of a statement about the downstream movement to even just the mainstream high net worth and then further down to the mass affluent, that makes me really uncomfortable. I'm very uncomfortable. I'm not sure that the math is compelling enough. We know how much manager skill matters and how much access matters. And it just doesn't seem like it's possible to replicate those types of benefits. And so the complexity sells, but at the end of the day, I'm just not sure that it adds a lot of benefit. I do think the space overall doesn't have to be harmful, but I would argue no matter how many zeros are in your net worth or at your institution, I'm still not sure they're necessary. I try to remain open-minded because maybe we'll go forward in 10 years or 20 years. And that viewpoint of these, maybe there's something about price discovery by going down to the mass affluent that is beneficial. I have no idea. I mean, that is a real possibility. I'm working on a book for next year and there's a chapter on alternatives. And there's a sentence in there where it's like, this could be the place where I am most wrong. And I do wish, Alexa, that I was a passionate believer. It would actually make life way easier. So that just goes to show you, as somebody who is in charge of overseeing the investment strategy, if you add complexity, everybody cheers. Mm-hmm. If you stay simple, it's much harder to prove your point. And so you do so with data, you do so with process. I have been pretty consistent in my views of holistic views since being in this role. And there's a lot of written content. It's one of the best reasons to publish. I think a CIO has become less of a person who's choosing investments and more of a person who's creating an investing experience. And you see the best CIOs are great communicators, They're also really good managers of people, which I'll admit is not my strength, but you run good teams. And the reason that's important is process. It's all about process and communicating and keeping people focused and not distracted. And I think it's just challenging when there are incentives, both in my role and to the people who are selling. And if you aren't doing anything, then how do you justify your fee? And I think in my space in particular, fees are under attack. Financial advisors who charge a percentage of assets under management are very much under attack by a group of non-profitable fee-only people. And influencers are being paid to run all over a system that actually does closely align conflicts as best as you can. And so it's just tricky.
And speaking of the low fee, high affluent category, I've even heard you say Schwab now is offering products in the alt space. So I'd love to hear more from you about what that tells you and what that thing is that in the book you're thinking, oh, maybe I could be wrong on this.
The thing that has me thinking I could be most wrong, and I'll reemphasize again, although people have probably already tuned out if they're like, this guy just hates alts. I think I'm very, very cautious. I'm more skeptical and curious than I am cynical. What bothers me about these sorts of investments making their ways into 401ks or this stuff, as you mentioned, Vanguard has a private equity fund just for their personal advisor services. Schwab and Fidelity are creating platforms as well. It's where the money's at. Traditional active stock funds, everyone has known for a long time now, are a ripoff and don't work. So that's a lot of lost revenue. Privates are active management, just in a different wrapper. You make a relatively undiversified bet relative to a broad market exposure. You're doing it based on a thesis. That's all fine and well. There might actually be real alpha opportunities. So that's probably why you justify the fee. But when you're going to small investors and saying that they need it, I don't actually think they're saying they need it. I think there is some demand for it, but they're trying to create demand as well. An example that it reminds me of is ESG investing was really popular at the end of the teens. And Wall Street was dying for ESG to be a thing because you can charge more for ESG funds than you can for index funds. The research is incredibly mixed. It's shockingly more positive or more effective than I would have ever believed. We actually have ESG portfolios, and I hated that. I was so mad that I had to build them. And I started reading all the research, and there are little pieces where I'm like, oh, that's surprisingly relevant. Not overwhelmingly so, but there's some data there that is interesting. But Wall Street was trying to create demand, and they had all this product. And the only reason there was real uptick in AUM flows into ESG is that people, actually, I don't want to say names in particular, were putting the funds into their models. And so investors were adopting them as part of a broad model that wasn't ESG focused. And a lot of fund flows were driven by one asset manager putting it into their models. That's where I feel like I don't know that the mass affluent or even the high net worth investor is really concerned about this type of exposure. The argument for why it is needed used to be lower expected returns of public equities, a fixed income, although fixed income rates are higher now, so maybe not. I would say that story has lessened. It's more about, oh, people are staying private longer. Oh, look at how much revenue these companies have. I mean, those are all facts. That is actually the hardest thing about this is so much of what's said about the private space in general is factual. Alexa, I'm just not sure all those facts are relevant. And so I think that's where having healthy debates is very difficult. Debating facts, something in investing, and it's why I love the FDA example. Investing is not black and white, it is shades of gray. And there's so much uncertainty in the world. And so with something like cost, that's probably another good example. Everyone assumes that lowest cost is what you need. Well, no, the research actually shows you that the 10th decile cost versus the 90th decile cost shows material significance in performance prediction. Everything in the middle is just a mess of we're not sure. Some of the facts are, again, facts. They're just not all relevant, and it's creating a lot of context. And that's probably why our allocations in this space are really tied to the client. What is your objective and your why for wanting this? And I would rather help a client fulfill their why than have them try to do it on their own. Our network is a little bit better. Well, actually, that's not always true. Sometimes our clients' networks are better than ours. They'll bring us opportunities and we're like, oh yeah, that's nice. But in general, our role is there to be their advocate, to sit on their side of the table. Yes, it's to be a fiduciary. I had a great conversation on my podcast with a behavioral economist, Mayer Statman. He's actually the first person who is published in a finance journal with behavioral finance, and it was in the 1980s.
Awesome.
And it's about investors' preference for dividends.
He's the black sheep. Yeah.
Yes. And so I asked, how do you think about meeting an investor want and being a fiduciary? And I think that's a challenging piece too. So it's like, if it's not in their best interest, but they want it, am I still a fiduciary? And that's a fun question to tackle. Now, I'm going to probably massacre whatever he said, but I'll make it even simpler. He basically said, well, if you're meeting a want and they can afford that want, it's not all that different than helping them plan a vacation and spending money on that. They might even make money from it, whereas vacation, they're going to lose money. And I was like, oh, that's very interesting. And it's a very personal approach. And I think it's a really great application of behavioral finance in general in a field where we typically just say, look at you silly little humans and make fun of ourselves. There's an actual practical application.
I appreciate how much of your job, having been in the role of the advisor, you're recognizing is how people feel about their investments as much as how they're actually performing. Speaking of staying the course, I do want to give people a chance to hear about some of the resources that you have put together for your own personal finances. What are some of the resources that are especially popular that you've put together that are available online for people to explore some of the Peter Lazaroff way?
Yeah. So the easiest place, especially because spelling Lazaroff is not always straightforward for people, you can go to The Long-Term Investor, thelongterminvestor.com. That takes you to my podcast page, but it also is the peterlazaroff.com page, and you can find all sorts of downloads that are a lot of just the basics. I think when I first started publishing downloadable stuff or personal finance things, a lot of it was just trying to show people the system that I used for saving money and creating goals and having a process for tying the money to the goals in a way where I don't have to think about it regularly. There's a resource that a lot of people like you ask what's most popular. I have so many custom URLs, but you can also find on the website. But if you go to howpeterinvests.com, there's a download that walks you through my portfolio, my balance sheet, how I think about the different risks. I'm actually writing a book now that comes out in July that you can pre-order if you really choose to pre-order your books 10 months in advance. But the last chapter is going to be a revision of this, how I invest my money, to align it more closely with the book. And I think the thing that surprises most people is something I've already shared, where all of my liquid investable assets are just in one fund. And people have a really hard time wrapping their head around that. And so it goes into a little bit of that. Happy to dig into as much as you want.
What's the main thesis of the new book?
The perfect portfolio's thesis, if I had to say in one sentence, is that there is no perfect portfolio universally. There is one perfect portfolio for you, though. Interestingly, or I think interestingly, the book was going to be called Your Perfect Portfolio, but one of my friends has a book coming out in November, and he changed his title to Your Perfect Portfolio from something very different. So I've actually had to pivot, but that's okay. But anyways, there is no singular perfect portfolio. You really have to understand what your needs are. And I think that if you're going to build what is truly the perfect portfolio, I think it requires some understanding of history, some understanding of human behavior, some understanding of the theory. It goes through some different asset classes. It goes through implementation issues. But if you're really going to manage your own money, you do need to have knowledge of history, behavior, and theory. And I think there's a lot of books when people say like, hey, I want to read a book. What's something I can read? And I have a really hard time giving just one recommendation. I'm like, well, you do this book for this and this for that. Can I give you 3 books? And my hope was, can I basically replace that with one book, and it gives you a little bit of everything? And if after reading that, you want to dive deeper, then yeah, there's lots of books that go deeper on the individual topics. But it should be relatively short versus many of the classics that I think are right. But the other thing that's interesting, when you read the classics, when you read A Random Walk Down Wall Street, or you read The Intelligent Investor, or you read Winning the Loser's Game, or stuff like that, they read a little stale. And I love those guys. I love those books, but I think here's just a refreshing a language that might make it a little bit more approachable to somebody who might not otherwise want to be dialed into more of an academic tone.
Yes. It requires a certain level of coffee to read some of the classics.
Yes, that's a good way to put it. Yeah.
I'm just very curious to hear, you had mentioned if you won the lottery today, there are some alternative investments you'd be interested to make. This is fun to think of the things that would get you over the line, to break your own rule and make that even Nordstrom investment during COVID. What's the thing that would break your own rule?
That's a phenomenal question. I think I would be most excited by something where I could somehow apply my knowledge and play maybe not a very active role. If someone's asking me for a check, chances are just giving me a board seat and letting me have at it. But I do think somewhere where if I could also offer some of my own intellectual property to make it better, that'd be interesting. Other than that, I always find health-related opportunities to be interesting. And I think a lot of that has to do with my childhood, growing up around medicine. When you're creating a product, and this is going to sound a little cynical, but particularly in technology, people always talk about disrupting. They don't talk about solving problems as often as healthcare does. And I love whether it's in medical devices or I wouldn't even know how to evaluate a pharmaceutical. I know there are those funds that specialize just in the ones that get past the first set of trials and the second. But if it wasn't something I could apply my own knowledge, I'd probably love to be in the healthcare space. But I guess if I'm applying my own knowledge, it's probably fintech. I say reluctantly. I actually have worked at a startup company, a fintech company for the past, maybe 8 years. And so I know what that experience looks like, at least, and have some knowledge there that I could probably apply. I guess that would get me to break my rule. That, or I'll tell you this, Alexa, I have a group of friends from high school who I talk to every day. And I always joke that if everybody quit their job and started a company in this particular text chain, I'm all in. I'll write whatever check you need. What do you need? You guys, you get it. It's all yours. You guys go run and go crazy. And I think that is, if I had that much money, you're just investing in people who you believe in and are smart. And you may not even totally understand the idea, but you just believe in the people. I think that's the type of money I'd have at $100 million. I'd probably take that risk.
Totally. If a VC is willing to quit their job in order to go start something, they've looked at so many deals and they know all the ways things could go wrong that's definitely one I consider for sure. And healthcare is fascinating. The capital I'm lucky enough to have inherited is because my father was in the business of bringing to market the first ultrasound machines. And that's the biggest improvement in obstetrics since probably doctors washing hands.
It's pretty amazing.
Just to be on the side of good. There's a lot to be said for putting your time and effort into healthcare. Well, Peter, this has been it's really fun to get to poke the bear a little bit. And I know our audience is often so excited about their own VC strategy that they sometimes forget all the other things you could be investing in and why. So thanks for giving us that bigger context.
Thank you so much for inviting me. I do love your show, and this is a lot of fun getting the opportunity to talk with you.
We won't call you a hater. You're really a supporter. We appreciate it.
I'm a curious skeptic at worst.
Thanks, Peter.
Thanks, Alexa.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.